Hello and welcome along to this Trade Zone presented by Eightcap. My name is Stuart McPhee and it's my pleasure to be with you here for this session wherever you are around the world tuning in and listening in today. So thanks again for your company. It's great to have your company. I hope you enjoy the session. Just so you know, I'm coming into you from Melbourne, Australia, where it's just gone 7 p.m. here on Wednesday. If you are unfamiliar with the GoToWebinar platform, which we use for this session, you should have access to a questions or a chat little window. Please feel free to access that and ask me any questions you want during the session. I'll be more than happy to entertain those and look at those during the session and hopefully help answer your questions and help you with your trading. Well, for this session today, what I'm going to go through, excuse me, is just going to run through a little, very short PowerPoint presentation. And the reason I'm doing that is I think it's important, and I've spoken to a lot of traders over the years, and I'm sure you have heard people in my position talking to you, whether it be some formal presentation or a webinar or live in person. And I think it's really important that you understand their background from a trading perspective and how they trade the markets and their beliefs about the market. So if you're in my session on Monday, I actually open up and share with you some of my core trading beliefs, some of the things that I find very important in trading and how I approach my trading, almost tenets, almost principles that I base my trading on. Well, I'm going to share something very similar tonight and talk about my beliefs on trading strategies. And of course, you can't really trade well consistently without a strategy. And I'm a big believer in having a trading plan, and we'll talk about that perhaps in another session. I'm a huge believer in having a trading plan. I think if someone believes they can trade consistently well over an extended period of time without a trading plan, I think they are kidding themselves 100%. It is just not something that anecdotally, there is no evidence to suggest that you can just randomly trade and do it for a long period of time and actually do well and make money. So as part of that trading plan, we obviously need to decide how we're going to enter trades, how we're going to identify trading opportunities. I like to talk in terms of, with my trading opportunities, I like to talk in terms of high probability, low risk. And what I find with most traders is they look to identify trading opportunities that are high risk and low probability. I'll say that again. I want to find high probability, low risk. Most look for high risk, low probability. So what I want to talk about now, just in the opening, before we go and have a look at some charts, some live charts, I will certainly talk about the Australian dollar and the ASX 200 index during this session, with the Central Bank of Australia having made a pretty significant move yesterday, and just have a look at the impact that that had on both the Australian dollar and the ASX 200. But before we do that, we'll get into just what I'm going to do is talk about my beliefs on trading. So these are specifically trading strategies, because as I said, as part of a trading plan, if you're not aware, the very first question you need to answer in your trading plan is, how do you enter trades? As simple as that sounds. You know, how do you look for trading opportunities? What conditions do you want to see in a financial product for you to say, that's a high probability trading opportunity, let's go, right? Let's open up the trade execution screen and execute a trade. So what I'm going to share with you just very quickly before we go and look at some live charts is some of my core beliefs on trading strategies. The first thing is be prepared to zoom out to gain perspective. What I'll do is I'll share with you a real example right now, and I'm mindful I just need to take a second for that delay to come through on your screen. So hopefully you can see my MT4 here with a chart of the euro. And what I've been noticing with the euro US of late is the significance of this level here at 107.50, right? The significance of the 107.50. And you'll look back here, back in April, this is a daily chart of the euro, where price for several days over the course of more than a week came down to this 107.50 level and bounced off, tested again and bounced off. Nice reversal pattern here, this sort of tweezer, almost a doji, not quite, but certainly a reversal signal. Coming back down again, sort of bouncing off 107.50 again, and then finally coming through. Retesting, now meeting resistance. And then more recently, in the last 2 or 3 weeks, we have seen this level stand up really tall and provide a lot of resistance to the euro. So there's now a glut of supply at that level, placing a lot of downward pressure on price. And you can just see, see the number of times that the euro's come up to that black line, almost as if everyone in the market knows that that black line is a thing and it's real, and all it is me drawing a line on a chart. But if enough people draw the same line on a chart, that has impact. That influences people's decisions. If I was looking to go long in the euro right now, I would see that black line, I'd see the resistance at 107.50, and it would be enough for me to raise a doubt. Just, I'm not so sure I'm going to go long here. I'm a bit concerned about that resistance level. And if enough people think that, guess what? The resistance level stands up and it becomes self-fulfilling. And if someone is long and they see the resistance level, they may go, I'm not sure if I want to stay in this trade much longer. They get out. That increases the supply. Me choosing not to go long diminishes demand. And guess what? Supply overwhelms demand. Price doesn't go higher. It actually falls lower. And that's what we're seeing just unfold now in the euro. Now, the point I'm talking about gaining perspective by zooming out, you may have someone trades on a 5-minute chart, 10-minute chart, 15, 30, 1-hour chart even. And if you don't zoom out to gain perspective, you lose sight of the significance of the 107.50 level. And I think there's a reasonable chance that 107.50 level is going to continue to play a role. It's going to continue to influence price by applying downward pressure on the euro US. And so if I don't see that, I can sabotage myself. I can get into a trade, go long thinking, well, this is about to roll up and head up, completely oblivious to the fact that there might be an overwhelming glut of supply sitting at that 107.50 level. And in fact, my potential profit might be quite restricted simply because it might get towards that level, not even get to there, just stop short, and then of course, meet all that resistance and roll over again. And I wasn't aware of that because I didn't zoom out to gain perspective. So in another session, and remember, I'll be here Mondays and Wednesdays for the rest of June. In one of the other sessions, I'm going to share with you, I think, a very simple procedure, but a very effective procedure or process to help you identify what your ideal time frame is, what your trading style is going to be, and what periodicity you should use for your charts. Really, really important. I digress a little because I think it's a very poor way to trade to think you can actually look at every single one of those chart periodicities on the menu and look at a 1-minute chart, 5, 10, 15, 30, 1 hour, 4 hour, 1 day and everything and think that's how I'm going to trade. I think that's a horrible way to trade. I digress. We'll talk about that a little bit later on. But I think you lose sight of the bigger picture. And in my eyes, I trade currencies on daily charts. I think it provides me, I think it's very logical what I see in daily charts. I think 1-minute charts, not so logical, a little bit more random. But anyway, that's the first of my points with regards to beliefs on trading strategies. Next one, trade with the most obvious direction. I'm a technical analyst and I love following trends. Now, maybe this is a topic for another session, but I love trends. I think prices, well, I know prices move in trends, and trend is obviously just a direction in which something is continuing to move. And we know that in the strongest of uptrends, we don't have 400 green candles in a row. There's going to be some reds in amongst that green, but the overall direction is going to be up in an uptrend. And of course, the trend can be different for different people because again, it comes back to that time frame, that trading style, that time frame you're looking to trade. But I'm a big believer in following the trend. And I never, ever, ever say that trading is easy. And in fact, I've been criticized over the years for being quite blunt and telling people trading is quite difficult. And I really still believe that. So I never say that trading is easy. But what I do say is trading with trend makes it less difficult. And I really do believe that. I just think trading with the obvious direction, where prices is tending to go, is more likely to go, increases probability. And I think just generally speaking, core belief on trading strategies is to follow the trend, trade with the most obvious direction. I'm not saying people don't trade against trend. I just think it takes far more skill, a lot more discipline, a lot more decisiveness. And, if you're a beginner trader, no beginner trader fits that mold, right? No beginner trader has that level of experience or skills in those areas. They're not disciplined, they're not decisive, and they're not highly skilled. They're not experienced. I just think the least difficult way to trade is with the most obvious direction. That's one of my beliefs. Another one is less is more. Don't trade every single signal or strategy. And I was doing a training session with a group of people yesterday, and I made this point quite clear that I think, why do we come into this trading? Why do we try to do this? We try to do this to make money. It's nothing to be ashamed of. It's pretty much everyone's primary motivation. And when we think about making money, well, the only way we can do that is to open trades. Make sense? Then we think, well, the more trades we open, the greater the chance, the greater the opportunity we have to in fact make money. So it's quite intuitive to think, well, I just need to put on lots of trades. Well, that gives me more chance, more opportunity of making money. And what I'm saying to you is, yes, it's counterintuitive, but I think trade less. Less is more. I tell people to trade quality rather than quantity. Trade quality signals, not quantity of signals, right? Quality over quantity. Trade higher probability, low risk, rather than just trading everything. So I just don't believe in trading every single signal nor strategy. Be a little bit more selective. I think your money deserves better. I also believe in developing your own strategy and becoming the global expert. Imagine having that title. No one should know your trading strategy better than you. You will be the master, the global expert of your trading strategy. Moving on to the next, just a few more beliefs on trading strategies. I'm a big believer in leaving your trades alone. In this entire trading plan and everything we're doing with the markets, you, unfortunately, and I don't mean any offense, you are the weakest link. You are the weakest link in all of this. And what I say to people all the time is don't interfere. Leave your trades alone. If you get into a trade, you set your stop, set a take profit level, set a trailing exit, whatever you may do, let your trading plan do its job. Leave your trades alone. You are the weakest link. Don't interfere. Don't second guess. Don't try, oh, I think I know better. I think this is good. No. Just you have a trading plan for a reason. It's there to protect you. There can be an illusion of control when you stare at charts. Comes back to my leave trades alone. You get into something, go and do something else. We now have technology. We've had this for a long time now, but when people started trading Forex, you couldn't put in your stops. You couldn't put in the conditional orders to get out at certain levels when they were hit. You couldn't do that. And you did need to, with currencies, you did need to get up at 2 a.m. and see how your trade was going. You don't have to do that anymore. Leave your trades alone. Don't think staring at charts will have some influence. I'm a big, believer with trading strategies is to avoid really, really short-term trading. I'm just discouraging you. I'm not saying it won't work for you. I'm just saying the chances of it working for you are not great. It's incredibly difficult, near on impossible, in my personal opinion. But we have this want. We have this sort of, it's almost intuitive. Again, I said back about why we're doing this. We're trying to make money. We make money by taking trades. More trades means more opportunity. Then we think we want that money quick. Therefore, if I trade 1 minute charts, not one day, not 1 week, that's too long. I'm going to trade 1 minute, 1 hour, 5 minute charts. We have this intuitively. We think, well, the more active our charts are, the more active the prices, moving on our candlesticks and the like. Again, that's where the action is. And trading currencies, for example, that's where the action is. That's where I need to be. I need to be trading 1 minute charts. And I don't say this lightly, but I've said it many times over the years. I think you almost have a better chance at a casino than you do trading 1 minute charts. That's my belief. Remember, the key word up on this slide is belief. It's just my opinion. Take it or leave it. Just my very strong belief on that. I also say that your good trades, your very, very best trades, take time. They just take time to pay off. Your very best trades are not overnight success stories. You may have one of them every now and again, maybe never. But your very, very best trades take time. What that means is you need to have the right risk management rules in place, exit rules in place. But more importantly, forget about all that. Come back to you. Remember, you're the weakest link. You need to have the discipline and you need to have the patience to see your very best trades through to the end. If you lack discipline, you lack patience, probably a pretty good chance you won't see that very best trade to the end, and you won't be able to look back and go, that was my best trade of the year, because you didn't see it through to the end, because you lack those skills or attributes, characteristics of the discipline, the patience, just having the right rules in place to make it very, very easy for you to see that trade through to the end and ensure that best trade of the year actually goes all the way to completion. And just finally on my beliefs before we go and look at some charts, I believe in you gaining an edge, finding an edge, gaining an edge in the market. Casinos do this with their rules. That's why they make money. They put the odds in their favor. And I think in trading, we need to think in similar terms. We need to find a set of rules that has a really good probability of, being successful, being profitable. It won't be profitable all the time, but if we can skew those odds in our favor, by getting that edge, that's where probability can work for us. And then more importantly, we need to do that consistently. We need to apply those rules consistently. Believe in your edge, validate it, prove it or disprove it, test it, review it, make sure you know it's going to work. This takes time. If you buy a trading system from someone, if you hear me share with you in one of the sessions maybe coming up, and I'll show this is actually one of the ways I trade currencies, don't take my word for it. It's your money, not mine. And I think it's important that you gain that little bit of belief and a little bit of confidence in what those rules are so you can stick with them. You can have the discipline to stick with the really, really important things. You have the discipline to adhere to the most important things in your trading, and that's all the risk management. That's setting the stops, taking the profit, the trailing exits, how we get out of trades, how we position size is really, really important. And again, I'm just shocked at how many people just don't really understand the importance of reward to risk, position sizing, and how you ideally should place different amounts into each individual trade, not just put in the same amount, and what that means mathematically and odds and the like. And probably my most important principle and belief, and I'll finish on this, is keeping it simple. I can't overstate the importance of keeping it simple. We have this want to make it very complex and very complicated. And I think that stems from us beginning trading, thinking it's going to be easy, and then very quickly realizing this isn't easy at all. I've just lost all this money. I'm now frustrated. So while it's actually now a little bit more difficult than I thought it was going to be, well, intuitively, I think I need to develop a really complex, complicated solution to have any chance of being profitable, being successful. And here I'm telling you, no, forget all that. Counterintuitively, keep it simple. Simple works. I mentioned this in my time with you on Monday, that it is absolutely imperative or critical that you develop a plan that's right for you, suits your personality, just sits very, very comfortably with you, and then you implement that plan with the right mindset. And I alluded to this a little bit just before, and I'll just finish up on this, and we'll go and look at some charts. Your trading plan, I cannot overstate the importance of having one. And again, how you think you can trade profitably over an extended period of time without one, I have no idea. So please convince yourself of the importance of having a plan, but don't be overwhelmed with, what goes in it. I don't know how to put one together. At a bare minimum, your trading plan should answer these 3 questions. And these 3 questions are: under what conditions will you enter the trade? How much money will you commit to the trade? And under what conditions will you exit the trade? How do you get in? How big will your trade be? And how do you get out? At the absolute bare minimum, that's what your trading plan should answer. I cannot overstate the importance of having a plan. I cannot overstate the importance of having a response, having a clearly defined answer to all 3 of these questions. How do I get in? How many? How much? How many lots, contracts, units, shares, CFDs? And how do I get out? I'll finish on this point. If you were to ask me what's the most important of those 3 questions, I would actually reverse the order very, very clearly. How you get out is by far the most important decision you make. How much money you commit to trades is really, really important. How you get in is not that important. Intuitively, without any experience, any trading experience, we think it's the opposite. How you get in clearly determines whether you make money in trades or not. Well, actually, it doesn't work out that way. But anyway, let's go and have a look at some charts. Look, I've already spoken about the euro a little bit. I'll just wait for that screen to come through on yours. Hopefully that's all coming through okay. I've already spoken about the euro a little bit. Again, even if you trade 5-minute charts, 10-minute, 30, 1 hour, whatever it might be, I think your first port of call should be, let's check out the daily chart. Let's just look at the bigger picture. Let's see if I can identify the trend. Is there a clear, obvious trend, whether it be the short-term trend? You know, the euro in the last 2 weeks is sideways, probably over the last month or so is up, but then clearly the last 3 to 6 months and beyond is down. So again, which one of those is important and is applicable to my trading style? You'll notice the very thin black line, which is a moving average running across the top here. These also are moving averages here. But this one here helps me identify for my currency trading on daily charts. It helps me identify the overall trend. And I can tell you right now, I never, ever, ever, I could say ever another 50 times, I never trade against that longer term trend, ever. I cannot be any more clear than that. It just helps me identify the overall direction. I never try to trade against it. I always want to look for opportunities to trade with it. That's what I'm trying to do. Trading against it to me is low probability. And what do I want? I want higher quality signals. I want higher probability. We've spoken about that a little bit, as I mentioned, just clearly right now, just having some issues with that 107.50 level. Wouldn't be at all surprised in the next week or so if it just continued to roll over. I'm not going to say it's going to drop drastically, but it's just going to struggle to get beyond that level. Could I be wrong? Absolutely, I could be wrong. It could fly up through 107.50 and be at 110 in 3 weeks. Of course I can be wrong, but all I'm looking at is probability. Remember, all we're trying to do when we do any form of analysis is look at the right-hand edge of that chart and say, what is most likely to happen next? That's all we're trying to do. What's most likely to happen? What's most probable? That's all we're trying to do. And I'm saying now, what's most probable is it's going to continue to struggle at that 107.50 level. Imagine yourself trying to push through a wall, maybe headbutt a wall, just can't get through. Eventually you go, I'm getting a headache. This is ridiculous. Why am I trying to push through here? You lose interest, headache, let's move away. Well, that happens with buyers. That's what happens with people who are demanding the Euro US. They lose interest. They may be long. They want to go, get into bigger positions, go long. It just can't get past that level. They lose interest, diminish demand. People who are long look to get out because they see them, it's not pushing through that level. So they try to get out. Guess what? That increases supply. It almost becomes self-fulfilling. That's what I see with the euro. I said I'd look at the Australian dollar, which is down here. So for those who don't know, the Central Bank of Australia surprised probably everybody, raising interest rates yesterday by 50 basis points. So that's 0.5%. And the official cash rate moved from 0.35% to 0.85%. Now, 2 months ago, the official cash rate in Australia was 0.1. It's now 0.85. So if you think in maths terms, it's actually increased by more than 700% in the last 2 months. So what we saw with the Australian dollar is, yeah, sure enough, here it is here, this candle here. So you can just see where my mouse is, really, really long shadow there, long tail wick. But when you look at it in the scheme of things, if you look at that 1 hour around when the central bank made that announcement yesterday, yeah, sure enough, it had a bit of activity and it moved around 50 pips or something like that, but actually just came back to where it was. So yes, it surprised everybody. And, there was a lot of activity, a lot of volatility, but at the end of the, 2 hours later, we look back and go, oh, was that it? Not much happened. Anyone was short probably got stopped out because it really, shot up, but it really just not much happened. We could look at a 1 minute chart and you'd see all that happening, the course of the 5-10 minutes around when the central bank made that announcement. But it's just interesting that, often we look ahead and we say, oh, well, the Federal Reserve will make their announcement about this, or the ECB, or the Reserve Bank of Australia, or whomever it might be, or the Bank of England, or they're about to make an announcement, and then it happens, they make a move. I mean, this was unexpected. I think a lot of people thought they were going to raise rates, no doubt, second time in 2 months, but the amount, the 50 basis points probably exceeded everyone's expectations. So it was very different to what was expected, certainly more than what was expected. And we saw a flurry of activity, but at the end, that was it. It was almost a bit of an anticlimax. And I think that can often happen, that we almost read too much into, oh, they're about to make an announcement tomorrow, the the central bank, head of the central bank's going to talk. And we got all ourselves into a not worrying about all this, and then at the end of the day, sometimes it really doesn't amount to very much. The other interesting thing with the ASX 200, which is sort of the XJO, the main sort of broad brush index of Australian stocks. This is an hourly chart. Again, if you just look just back to the daily chart, again, not much happened. Not much happened. I did a quick market scan just before I came on in this session. And I can tell you, out of the top 200 companies, which are represented by the ASX 200, in the last week, 14 of those stocks have achieved a 1-year low, 12-month low. 14 stocks have achieved a 12-month low in the last week, and 7 stocks have achieved a 12-month high in the last week. And it's one of the little tools that I run, and I do have interest in Australian shares, and I'm reasonably active with them, not as much as my currency trading, but I do get involved in ASX shares, And one of the things I track just from a broad market breadth, having a look at what the market might be doing, I just look at highs and lows. Yes, I follow the index, but I look at how many stocks are reaching all-time highs or 12-month highs, and vice versa. How many are reaching 12-month lows or all-time lows? And when the number is double what the other is, so at the moment we have 14 to 7, so more double stocks are achieving 12-month lows in the last week compared to 12-month highs. And I'll watch that over the next week or two. And all it does is show me, well, I know what I'm seeing with the index, but remember the index is weighted, and most are in the world. Most indices are weighted. The larger of a company, the more of an influence it has on the value of that index, which can provide a distorted view of the market. Company 100 has much more of a say on what the index is doing than company 200. Sorry, did I say 100? Company 1, I beg your pardon. Company 1, 2, 5, top 20 have much more of a say than companies 196 through to 200, where companies 196 through to 200 may as well not even be doing, may as well not even be there because they have such next to no weighting, no influence. So the index can provide a bit of a distorted view, and just looking a little bit, it's almost peeling back the curtains, just to look a little bit closer at what is going on within those top 200 stocks can be quite useful. I also mentioned this yesterday, and I just zoomed out a little bit, and I just showed some key levels there around, what were they, around 7,000. I could draw these lines in here if you want, 7,000, somewhere around here, and 7,600 at the top of the range here. That's very rough, but that's sort of where it's been, almost 12 months now. And in mathematical terms, 7 to 7.6 on a 7,000 index, what are we looking at there? Less than 10%, maybe around 8, 7 max, that's it. And that's at the extremes. So it hasn't been a huge amount of movement over that period of time. I know it's sort of ducked below here and likewise and again, but what I'm doing there with those black lines is pretty much capturing the bulk, probably more than 80% of the price in the last 12 months. And that just shows me this frustrates people because it hasn't gone anywhere. We don't have that clear, obvious direction with the index. If we peel the curtains back and look deeper into the stocks making up that index, yes, we can find high performers clearly outperforming the index, and of course those that are underperforming to either go long or short. And there are ways and techniques in which we can do that. But if we're just looking at the index itself, 7-8% at the extremes is not great. You can leverage up a little bit, obviously. Clearly that just takes on additional risk. But they're at the extremes. That's timing it perfectly. You don't go short at the top and go long, reverse and go long at the bottom, and that's timing it perfectly. And there's certainly, and that's over 12 months, which is a really, really long period of time. So it really hasn't provided a lot of opportunity over the course of the last 12 months or so. It just hasn't. Just finally, looking at the British pound, I also had a look at this yesterday with the group I was with, and I was just looking at this 130 level. And if you think in terms of 130, it's a nice round number. It's a multiple of 10 cents. So it's very easy to think in terms of, that's where people tend to gravitate and think about price. 130, 1.3 is a lot more obvious to someone than 1.2980 or 1.2870, right? 1.3, 130 is just more obvious. It's an obvious target. People on their shorts will go, what a great target. If it got down to 130, I'd love to close out that short. And again, it's an obvious target. And if enough people think that, guess what? They're going to sell. And how do they sell a short position? They buy it back. It increases demand. And if it can become self-fulfilling, and over the course of more than a month here, Yes, it rallied up above 130, but down through here for the course of 2 weeks, it just got down to 130 and bounced off again, bounced off again, bounced off again. So it's actually quite significant that rather than just continuing to bounce off, when it actually did break through, that's really significant given how strong that support in fact was. So significant that you can see how strongly it fell. It really didn't just turn around and have a look backwards and say, oh, 130 is just there. No, just headed in one direction and just fell really, really sharply. Followed that up with another strong move and then another strong move, tried to rally a little bit and then just got smashed again. So when these key levels of support and resistance stand tall, they become really, really significant. When they're broken through, that's even more significant when it maintains that break. It's really strong when that happens. It's almost a complete change in sentiment. And again, specifically with currencies, when you think about the amount of money going through these currency pairs to move them that much, it really just adds weight to what you are in fact seeing. You're not seeing a little penny stock here that's worth 3.2 cents. You're looking at one of the largest currency pairs in the world with a lot of money going through it, making this happen. Well, I think that might be my time for today, Wednesday, the 8th of June. Again, thank you very much for your time. I know everyone's time is valuable, so thank you for sharing that with me. It's great to have your company. I hope you can join me again next week on Monday and Wednesday and the week after, and we'll go through a little bit more education about the way I view markets. We'll go and have a look at a few more instruments and hopefully share with you some of the ways that I look at the market, ultimately with the goal to help empower you to develop that trading plan that you are going to have and you're going to implement with confidence in the market. So thanks again for your time, and I look forward to seeing you in another session again next week. Thanks very much.